So, hi everybody. It's really great to see you all here. And Arjen really asked me to talk about two things. Is how do you get funded? Like what do you have to do? And if you are getting funded, why it might be worthwhile thinking to get funded in the US as opposed to Europe. Sorry, some European guys, investors. Anyway, let me tell you a story about how we initially got funded, accidentally I would say, 4 years ago now. So imagine we're actually doing pretty well. By the way, our company is coming from Lithuania. For those of you who don't know, it's like right next to Poland. And one day I'm sitting in the office and one of the guys brings me a telephone. And because I'm one of the few guys in the office that actually speak English, and I pick up the phone. And we're in the church, so forgive me for comparison, but I hear the voice of God saying, "Hello there." I'm like, okay, hi. And the guy goes, "I'm Rich Wong from Excel Partners." You know, like literally, like God is speaking to you. I know those of you who do know Excel. Okay, so for those who don't know Excel, it's actually one of the really top world VC firms. They invested in Facebook, Groupon, so they are really big guys. I mean, they assumed I would know them. I say like, Excel Partners, so how can I help you? You want like, to download an app because we're an app store. He like a little bit lost, and then like, toned down, and then goes like, well, we're like venture capital firm. We invest. What I observe in the startup world is too often I see companies are being built to get funded. And typically that's the other way around. That's supposed to be the other way around. Companies are getting funded to build the business, right? So if you really want to get funded, don't try to just build the business. I mean, as investors would say, featuring all the typical properties that a startup business would do. You're not building the business to get that funding round. That would be nonsense. The best startups really focus on the product. They may have no clue what VCs are, what they do, how they do, and what preferred shares are, and so on. But if you really build a great product, VCs will come. I mean, those VCs who are sitting for you, that's what they will tell you. They are not seeking for guys who just built a business to get around. They are building for guys who are knowledgeable, who built a great product, who really know what they are doing, and then it's really easy to get funded. Then you don't have to really, spend your time, trying to convince an investor that this idea is crazy or not. Anyway, so that's the first part of the story. The second part is really a little bit about the VC environment in Europe and the United States, right? So I would say if you are really a very early stage investor, startup, then say European environment is actually pretty good. Good in a way that you can have access to quite a lot of easy, cheap, unmanageable, and controllable capital, especially provided by EU grants, as for spin-offs and for R&D programs and stuff. So actually, if you're seeking for, say, early stage funding, it's pretty pays to seek in Europe. You can find like a lot of sources. Now, what I observed, and this is something that Arjen asked me to discuss a little bit here, is generally you will find that European VCs behave slightly differently. They seek for slightly different things in the business, and very often you might think of maybe going to the US and just looking around if American terms might be better for you. Because again, there is no like one size fits all here. Every single startup is unique. Everybody's developing a different technology. And while some ideas may be massively better funded in the US, some other ideas may not get any attention at all. For example, in my specific case, we are building a mobile application store. And a few years ago, a big part of our business was, say, all these Nokia Symbian platforms that never really existed in the US. So when I was doing my second funding round 2 years ago, there was kind of a dilemma. Because on the one hand, I knew that if you go to American VCs and you convince them that it's worth investing in you, then sometimes you get funded on a twice as high valuation. Literally, I'm not kidding. We're not talking about 10%, 20%, 50%. sometimes the difference in valuation is 2 to 3x. And the reason is very simple, because VC model is invented in the US. And too many European VCs, not all, I would say half, don't even understand the venture model itself, the high risk, high reward model, and try to, say, invent, or not invent, but create valuations based on EBIT or all the other, say, old economic models. For example, they don't take into account the extremely high flexibility and dynamics of the growth market. So as a result, they pay, well, fine, how much profit your company has. Let's multiply it by 5, and let that be the basis for your valuation. And that's, in the US, that's nonsense. On that model, Twitter would never be funded at all, because they never really had that EBIT and so on. So anyway, so there's a lot of different things in the US. So in our case, I thought, okay, maybe thinking for an American investor makes sense because our valuation would be higher, and our terms might be much better. On the other hand, Americans have extremely US-centric view of the world. As I was explaining here in the break, if you talk to typical American, they would say, here's America. Like to the left, something that produces our clothes. To the south, it's an endless source of Mexicans that work at our house. Like to the east and down, they make digital cameras, televisions, and here's troublemakers, like all the Arabic countries. And that's like ex-communists. That's it. So when I tried to explain that, Nokia, Symbian, at that time, I take my words back now, 4 years ago, but at that time, I was trying to explain it's a big part of the business. They would never really understand us. They would say, it's not BlackBerry, it's not iPhone, done. Anyway, so what I'm trying to say here is that, again, in each specific case, in each specific startup, in each specific business, there are a lot of, say, moments. And not necessarily, if you want to compare two term sheets from two European investors, is the best way for you. So if you're not an early stage, if you're middle to late stage, it is really worth just visiting Silicon Valley, on a similar events as this, getting to know some VCs there, and talking about the opportunities. And really best if you're able to compare a couple of term sheets. Some of them are coming from European investors, some of them are from US. Because then you can really decide what's best for you. And in some cases, by the way, you may decide that not only you can take the money from the US investors, but you can actually create a part of your business in, say, Silicon Valley, because believe it or not, but Silicon Valley today is really one of the biggest IT hubs. So, whatever startup, it really pays off to, say, to just explore the opportunities there. So this is a little bit on European VCs versus American VCs. I hope that European VCs don't take the message personally. And now I'm really open to any questions you may have. Sure. Well, I think that European VCs, that's my personal observations, are best at understanding what I call the old economic models. So if you really want to fund the growth of, I don't know, chain of restaurants or chain of hotels or some business which is more or less classic business, old economic business, I think they understand those models really well. And these models are based on the ROI, on predictable growth. You can really calculate literally, down to, say, a couple % how a restaurant will behave if you have one model and so on. So whenever you're seeking to fund something which is closer to the old economic model, European VCs are great. Because again, they understand it well, they understand really the specific European market, and I think they can be really great partners. Now when it comes to something which is new economics, the phenomena of Facebook and Twitter, European VCs, I would say, are too conservative to try to understand the models behind those. So again, you cannot measure value of Twitter by EBIT, period. And I know personally a lot of European VCs that unless you have stable, predictable EBIT, they will not even go into any valuation at all, because based on all economical schools and on the theory that they have back from University of Keynes and Adams, this is, say, the way to evaluate businesses. In that case, you just may find it either impossible at all, or if they do to you and come with a term sheet, what you may find is that evaluation is really, really conservative. Again, my personal experience, when during the second round, I did compare European American VCs. So the average European term sheet would be 2.5 times less than the average American VC. That's pretty significant. So that's my observation. If you're trying to fund a Twitter-like case, then America might be a better way. If you're trying to fund something more like classical established, then Europe is pretty good. Anybody else? Sure.
What do you do with the
what did I do with the money? Well, that's a great question. Well, I'm not like those American businesses that get more money to get more growth and burn more money and then get another round and so on. Specifically in our case, again, a year ago, we decided that we want to optimize the company for strategic value as opposed to cash. And by the way, if you're a startup, I think this is one of the first questions you really need to answer yourself is what is your exit strategy? And do you optimize your business for cash or for strategic value? Cash is a really stable game because there is always a buyer for cash. Strategic means way higher multiple because you're developing a very specific technology or market presence, market position that is strategically significant to potential acquirer. In that case, revenue doesn't matter, and they can build multiples which are unheard of in the classic economics, right? So AdMob was sold 37 times revenue. I don't know how many EBITs. I mean, just crazy. It's just unheardable. So because we are a mobile application store, and because we see that today, say, Google and Android and Windows are trying to close this space, we decided to build an independent alternative. So basically decided to go for a platform game, to be completely independent, completely, say, encapsulated, own platform owner, allowing web companies distribute outside Google and Apple and all these companies. And that is a highly strategic investment. So that is a platform investment. That means that typically we have extremely high development costs because, again, building a platform is very expensive. Today we have like over 70 engineers, and we're going to double in the next year. And probably we can say spend another, say, 100 million just to get it off the ground because, again, technology game is always very expensive. And that specifically when the money would be used purely, like 95% to fund engineering and product, much less marketing and everything else. Again, specifically because in our case, we decided it makes sense to optimize the company for strategic value and market position as opposed to cash stream. Sure. That is a great question, by the way, right? So first of all, both based on, sorry. Yeah, so did we have a goal before we got funded? So again, my observation in general in life, and by the way, GetJar, the current is my 10th project. So I've done quite a few of those before. And what I discovered is that nobody, I don't think anybody is smart enough to really see and predict a successful business. And my observation, if you look at the best companies, Google themselves, you never end up with something you originally planned for. You never do. With GetJar, we were trying to build a beta testing platform for mobile apps. We ended as an app store. We decided to change to mobile platform. Google never started with the idea of having all those auctions on advertising. They were building a search engine. They were massively unprofitable. And only 7 years later, they discovered, hey, you can make money off selling all those silly ads, and make billions and billions on that, and so on and so on. You take a look at every single company, you will never find that the successful company is something that was originally being planned. I mean, my experience, it never happens. So the conclusion, it is pretty important to be flexible. And I think flexibility is one of the most important things that a small company has. It can change its course in a week time. Something which neither Microsoft nor Google nor anybody else can do that quickly. You can adjust. I think that's the biggest strength that say, a small, young, dynamic company has. So in our case, again, originally, 5 years ago, we started the whole thing as a beta testing. Actually, it was a utility, a tool, helpful for our main business of doing mobile games. It allowed us to crowdsource testing of mobile games. So we wouldn't have to spend much time on and money on porting and testing. Quickly it rolled out into a distribution platform. Then we got funded originally as a distribution platform, and then Apple came with the App Store model. So we just changed the whole model slightly and saw the value in building App Store and so on. And again, the most recent round we closed February this year. That was specifically on the promise of the platform. So I would say we slightly changed our course 3 times, and adjustments to the course you make every month. Never ever I've seen anybody who said, I will do that, and 3 years later he says, okay, on that funding, on that promise, actually I've done precisely that. But again, as you move, you build your company, you build expertise, you build technology, you observe what's happening in this space, and again, if you're flexible, dynamic enough, you can always find a way how to improve or change your business. I don't know if it answers your question. I think we have one last.
How do VCs react to flexibility when changing your business course?
Well, it's a great question, right? There are actually 2 questions, right? One is if VCs has any influence at all on your strategy, because some do, some don't. At some stage, you actually want that involvement, and some you don't. So again, the general matrix would be if you're like really small, like seeking for Series A or seed money, then actually you do want VCs to be actively involved in your company, because at that time you need a lot of hand-holding, explaining the basics, helping with introductions, building the board, and so on and so on. So at that time you want to give active control, some at least reasonable control to VCs, because you will have value of that. Now, as you move up, like if you're established later stage company, you typically would have your executive team built of pretty, strong professionals. So at that time, nor you don't want VC to tell you what to do, because your executive team is 24 hours thinking about your business. VC just learns about your update like once a month. So even if that VC is qualified well, he will not ever spend enough time and be enough involved in your business to really do quality decisions for you. So generally, the later you move, the less involvement from VCs you want. And that also depends on the type of VC. Some VCs like active involvement. So they ask for board seats and they actually tell you what to do. And those typically would be those that are coming from entrepreneur background who say, my experience can be useful to you and so on. And some VCs upfront declare, what, our strategy is be passive. So we don't try to interfere with what the company does. And we don't try to tell you what to do, because we just, by virtue of investing, we trust your team and we trust you to do quality decisions. So on one dimension, you have early versus late. Early, there is advice. Late, there is none. On the other dimension, you have different VCs. Ones are active, ones are passive. And you have actually a choice. And in our specific case, say our first investor was Excel. And one of the reasons I went with Excel, because of the added value, because we have all these contacts, we have great partners to tell you what to do. So we did want some advice. The second investor was Tiger Global. Actually, it's not even a VC, it's a hedge fund, and we are totally passive. And we were specifically looking for passive, because Excel would actually let us go and say, look, now that you have executive team, you can do whatever decisions you want, because you're professional now. And upfront, Tiger was like passive, because that is their strategy. So in our specific case, we were pretty independent in those decisions. Apparently, you need to convince the board that they are right. But in our specific case, they didn't really decide for us what to do. But I've seen different models. I've seen some entrepreneurs struggling with the boards. I've seen some entrepreneurs who don't realize themselves that they need help and do stupid decisions and then regret and so on. So decision on how active or passive you want to be your investor, you have to make. And I think it has to be part of a discussion process when you do a funding round. So organizers, I guess we're pretty much done with the time.
Yeah.
So thank you, everybody.
Thanks. Great talk.